This segment of video, created for my intermediate accounting classes, covers more material from chapters 10 and 11 in the Spiceland text, modifications and additions to property, plant, and equipment. Additions to property, plant, and equipment subsequent to the acquisition date fall into two primary categories. There are those types of modifications that actually improve the existing asset, that is, that allow it to do something that it could not do before, and those that simply extend its life, that is, the machine after this modification can't do anything differently than it did before, it can just do it longer. Those that improve the asset should be capitalized, that is, added to the asset's recorded cost, whereas those modifications that simply restore it to a previous state of functionality are charged to accumulated depreciation. Let's look at an example. ABC Corp owns an earth mover with an original cost of $230,000 and accumulated depreciation of $85,313 as of December 31st, 2017. The machine had an original estimated useful life of 8 years and an estimated salvage value at that time of $20,000. First question, this is just something I want you to be curious about or be able to address, that is figuring out when this machine was put into service. Well, let's assume that the company uses straight line depreciation, and if so, then you can figure out what the annual depreciation expense should be, and from that to figure out how many years of depreciation have been taken. First, note that the annual depreciation would be $230,000, the original cost, less $20,000 the estimated salvage value when put into service, divided by the 8 years estimated useful life, or EUL, at that time, or $26,250 per year, the depreciation. That means the asset then has been in service for 3¼ years. That is, the accumulated depreciation to date, December 31st of 2017, divided by the annual straight line depreciation, $26,250, is 3.25 years. So backing off from December 31st, 2017, back 3¼ years would take us back to the 1st of October. That is the beginning of the final quarter, 4 years before actually, October 1st, 2014, 3¼ years prior to the December 31st of 2017. Okay, given that, now we want to be able to write the entry assuming that a fuel regulator is attached at a cost of $12,000, which will allow for energy conservation and fuel savings. This adds to the asset's serviceability, but does not extend its useful life. And so we want to first of all be able to record that entry and then to recognize that that change will result in a revised annual depreciation amount. So first of all, let's write the entry. Since this is an improvement that adds to the serviceability or the functionality of the equipment without extending its useful life, then we debit the equipment account. In this case, we might have a more, let's say, more precise account title for this. It might be production equipment or production machinery or something like that. But in this case, I'm going to stick to vanilla title equipment. So we debit equipment for $12,000 and credit however we paid it. If we issued a note payable, that would be a credit to note payable of $12,000. Now, what will be the new annual depreciation expense? Well, we have to recalculate the depreciable base because we've made a change now to the asset account. Now, here's where I strongly encourage you to do what I do, and that is to set up T accounts. Set up a T account for this equipment where you would show the beginning balance of $230,000, and you would also show under the accumulated depreciation a T account for $85,313. Okay, that'll be important more so later on, but it's also healthy for you to be able to think through more complex problems this way. So the depreciable base is going to be revised. We're going to take $242,000, of course, which is the $230,000 original balance in that asset account, plus the $12,000 debit that we just recorded, less the accumulated depreciation at that as of December 31st, 2017, less the $20,000 estimated useful life. By the way, This is any time is a good time, but particularly at year end, if there has been a material change for some reason in the estimates of your expected useful life, then that would warrant a change in that and a recalculation of the depreciable base, even if in fact there had not been an addition during the period. But in this case, we did have an addition. So anyway, notice what we've got here. We've got the depreciable base. Now, when we first started out, that was the $210,000, $230,000 original cost, less the $20,000 of the estimated salvage value, $210,000 divided by 8, the original useful life. Well, now we have to revise that. So we start by calculating our depreciable base, $136,687. And of course now we've already had 3¼ years that have transpired, so 8 minus 3.25 leaves 4.75 years remaining to depreciate this asset. Notice that $12,000 adjustment that we made, or addition that we made, did not extend the useful life at all. Even if in fact that piece of equipment could function, let's say, more years than that, because it's attached to this equipment, which has got only a life of 4.75 years, then we will depreciate even this new portion of the asset, this addition, over the remaining useful life of the asset to which it was attached. Well, that gives us a revised annual depreciation of $28,777. Now let's go back to the starting point here and kind of and look at another possibility, and that is a type of modification or addition that in fact does not increase the serviceability or improve its functionality. In other words, the equipment can't do anything better than it did before, but it can do it for longer. And so we spent $6,600 on an engine overhaul. And although the serviceability of that machine is unaffected, the life of the machine is extended by 2 years as a result. Notice here, we're simply undoing, as it were, depreciation, debiting the accumulated depreciation equipment account for the amount of the expenditure and crediting cash. What will be the new annual depreciation expense? Well, once again, if you've set up T accounts, start back at the beginning and see what change is going to be made. That $6,600, of course, is going to be debited to accumulated depreciation. And so we will go through the same process of figuring out what the new depreciation expense per year is going to be. But as before, let's first of all revise our depreciable base. It was $230,000 before, minus $78,713. You see, after we've posted this $6,600 debit to accumulated depreciation, that reduced the accumulated depreciation balance, minus the $20,000 of estimated salvage value. I'm having trouble with that one today. Gives us a depreciable base. That is a remaining depreciable amount of $131,287. But notice here we also have to revise the denominator. That is, the estimated useful life is now 6.75 years. That is, the 4.75 that would remain on the asset were it not improved, plus the 2 years that this engine overhaul is going to allow. So the new annual depreciation expense is $131,287 divided by 6.75 years, or $19,450 per year. So note these two basic changes. I don't believe, by the way, that Spiceland covers this particular topic, but I thought it to be a relevant and important one as we address some of the issues that, or the entries that a company would have to make related to the maintenance and the operation of PP&E. By the way, I don't guess I've mentioned it before now, but if in fact a particular expenditure is simply going to provide benefits for the current period, for instance, an oil change in a truck, we assume that oil changes might have to be made regularly, multiple times a year even, in a delivery truck, so that in fact no one of those oil changes or other types of ongoing repairs or maintenance, those are not assumed to benefit future periods, and so they are recognized simply as costs to be expensed in the current period. So repairs and maintenance expense is where we would charge amounts that expenditures that are really going to benefit a particular period. But these other two modifications and additions, we are arguing that in fact they will benefit multiple periods, and so we have to capitalize and depreciate those. Well, let's return to the idea of selling of property, plant, and equipment. I think we've already seen this in general. A gain or loss is going to result whenever a fixed asset is sold for a gain is going to result when a fixed asset is sold for more than its net book value, and a loss is going to result whenever a fixed asset is sold for less than its net book value. Net book value, of course, being the equipment balance in this case, less the accumulated depreciation on that equipment. Well, let's look at an example and walk through another instance of gains and losses on sales. The date's March 31st, 2018. A delivery truck with an original cost of $41,800, estimated salvage value of $5,000, and a 5-year estimated useful life is being depreciated by the straight line method. At the recent year end, the accumulated depreciation for the asset was $34,500, and I challenge you to go back and figure out what when that asset was put into service. Determine the gain or loss on the sale if the selling price is $7,400 and write the journal entry to record that sale. Well, first we have to record depreciation expense from the most recent year end, December 31, 2017, up to the date of the sale, that is March 31st, 2018. So to do that, we have to first of all figure out what the annual depreciation amount was, given that what we've been told about the original cost, the estimated salvage, and useful life, and the depreciation method, that is straight line. We can here see that it would be $7,360 per year. So the required entry to update depreciation as of March 31st, 2018 is a debit to depreciation expense and a credit to accumulated depreciation equipment for $1,840. Notice how that amount is figured. $7,360, the annual depreciation amount, times 3/12. That is the period from January 1st of 2018 to March 31st of 2018 represents 3/12 of a year, or 1/4 of a year, and therefore that we update that depreciation in that way. Okay, well now, having updated the accumulated depreciation balance, we can now record the sale of that equipment. $7,400 is debited to cash. Once again, it could be that we sell it and receive a note receivable or some other type of merchandise, but this is the simplest circumstance here, just debit cash for $7,400. Notice we have to get all the updated balances related to that equipment off the books, and so there's accumulated depreciation equipment. Notice that reflects that additional $1,840 of depreciation that we recorded in order to update the depreciation as of the time of the sale. And also we're crediting the equipment account for $41,800, and the gain on disposal of equipment in this case is really just a plug figure. The gain is what results. Notice in this case we have a gain because we sold the asset for $7,400, but in fact the net book value of the equipment was well, it was less than that by $1,940. I didn't figure that out ahead of time, but you can figure that out for yourself. By the way, going back to this one, if in fact, of course, the amount of cash that we'd received, let's say, was $4,000, then in that case, the amount of the selling price of the equipment would have been less than the net book value of the equipment, and we would have recorded a loss in that case.